Now, today is such an important topic because we'll be discussing inflation and volatility and looking out for key opportunities, possible opportunities that you might want to listen to as part of our analysis for today. Now, while we wait for some people to come into the room, once again, remember we're here to guide you to be a part of being that bridge between us and the experts in analysis because we're always leading with knowledge and financial literacy. So we're here to help you make better investment decisions. So join us today, ask your questions in the Q&A because that's a key part of the learning process. And of course, I always want to hear out what you want to know about and what is really important in the forefront of your minds in terms of analysis. So today, the topic we'll be discussing navigating inflation and volatility with income. Now, when you think about inflation and you think about volatility right now with the market, you're always thinking about how can you build resilience? How can you build wealth during these unnerving times? And I think one defining factor for that would be uncertainty, right? We're always looking for where the next opportunity is. And so today it's really about going into real estate investment trusts. We're talking about REITs. We're talking about the rising rates environment and really how to navigate these times. And I understand there are already a lot of concerns out there. So without further ado, let me talk about, not just about, the key analysis, but also having you as part of the discussion towards the end. So from UOB AM and moomoo Singapore, we have Vice President of Intermediary Sales, Ronald Ng, and also Senior Manager of Corporate Institutional Sales from moomoo Singapore, Leong Shern. Hi, gentlemen.
Hi, Olivia. Thanks for the invite be on this show.
Hi, Ronald. Hi, Young Shern.
Hi,
So, Ronald, what can the audience expect from today, especially with this topic?
Yeah, so for this topic, right, we recognize that for this year alone, it's actually a very challenging year for most investors. Equity markets, fixed income markets have all suffered a deep correction. And main reason why the markets corrected is because of three main risks. First, the investors are concerned about, which is the risk of over runaway inflation, risk over rising interest rates, and also the geopolitical risk between Russia and Ukraine. And to
Absolutely.
navigate through this environment, I think it's important for us to have a deep understanding in terms of what inflation is all about, because only by having a deep understanding of inflation can we then understand why some of the governments are enacting certain macro policies in a certain way, which have dramatic implication on financial assets, which I will cover more in the discussion later.
Absolutely. I'm looking forward to that. And I'm sure you have a lot of insights that we can learn from. But also for Young Shern, you'll be having some demo training for us, right?
hi, Olivia and everyone. Yes, we will be showing you how to buy. Not only as usual, we will be showing you how to buy funds. And today we have observed this change in the trend of investors' behavior towards some more stable product or some funds product.
I
So
look forward
stay
to it.
tuned.
We'll stay tuned till your pod. So for Young Shern, we'll be right back with you shortly, okay? We'll see you soon.
See you.
So back to Ronald, just to set the context for today and to really dive straight into the topic, navigating inflation and volatility using income. Now, could you just do some contextual analysis on how you can define what it means to, have inflation or volatility as part of, something that we have to navigate when we're trying to find new opportunities in our portfolio, and maybe share a little bit on your thoughts based on contextual analysis.
Yeah, so basically what happens is this: when inflation is really high, right? Central banks are forced to act, and what they will do is that they will enact certain macroeconomic policies, such as hiking your interest rates, or they could be raising taxes, or they could be, enacting certain monetary supply policies, such as, removing liquidity from the market, known as quantitative tightening. And all this have, certain implications to financial assets. And so that's why in order to navigate through this environment, it's important for us to have an understanding of this. Then we can preempt what governments are going to do, and in so try to sort of front run the government and position your portfolio to ride with the markets. Yeah.
Right. So perhaps you could even share some reference points that you've prepared for us, so that audience can have a visual representative of your analysis today.
Yes, perfect. So maybe we can jump straight to slide number 2. Yeah, okay. So today's I will first talk about what's currently happening right now in the market in terms of inflation, and then I will move on to look at some of the policies that government has actually enacted. Now, moving on to the next slide, slide number 3. What you see on this slide are some of the news headlines that have been flashing in the various newspaper. In July, the first headline that you have seen on this slide is that US inflation has quickened to 9.1%. So 9.1% is actually a 40-year high inflation rate in the USA. And soaring inflation has actually dramatic impact to the civilians. It causes economic pain. And here in Singapore, I believe we are also not spared. You can see that COE prices have actually hit a high of 114,000 in July, and this is actually like a threefold increase compared to pre-COVID levels. Gasoline prices are also on the rise, and we are now seeing many new million-dollar HDB flats transaction taking place all around in Singapore. So this creates a lot of problem for many new aspiring homeowners, and we also seen in the newspaper that government is now starting to step in with their recent property cooling measures for in terms of the property loan maximum quantum that one is allowed to take. Moving on to the next slide, slide number 4. So why is high inflation bad? High inflation is bad is because it erodes the purchasing power and leaves citizens feeling poorer. So the thing about inflation is that it's a mysterious beast. It's very hard to control, and it can easily spiral, and so let's look at this example. What happened in Venezuela in 2018? The inflation rate actually hit 1,000,000%. So let me repeat, 1,000,000%. So what this means is that, if goods today cost $10, a year later, it will increase by 10,000 times. So for example, if let's say a bag of rice costs $10 today, 1 year later, due to 1,000,000% inflation, that same bag of rice would cost $10,000. Sorry, $100,000. What this means is that your citizen savings will get wiped out, and it will create social unrest and also social instability in the country. And that is why government is so adamant about controlling and curbing inflation. Now, moving on to the next slide. So when inflation rate is high, central banks are forced to act. So for us, I think it's important to understand the roles and responsibilities of these central banks, because their policy actions can have a very dramatic impact to financial assets. So what is a central bank? A central bank is a public institution that controls the amount of money in circulation, and they have a main policy aim, which is to maximize employment and ensure price stability. So when inflation rate is too high, they will cool it, and when inflation rate is too low, they will seek to stimulate it. Over here on this slide, you see that there are 3 major central banks in the world: US, Europe, and Japan. So they are namely the US Federal Reserve. In Europe, we have the European Central Bank, and in Japan, we have the BOJ. What do you notice on this slide? On this slide, you will notice that their main policy goal is to aim 2% inflation over the longer term. So that's the consistency. Now, the next question you might ask is, why 2% inflation? Why not high inflation? Why not like a deflation? Moving on to the next slide, slide number 6. The main reason why central banks target 2% inflation, firstly, is because it ensures price stability and maximum employment. Just now, based on the example they have shared, high inflation is actually bad for the economy because it causes social unrest, and it also result in businesses going bankrupt due to higher costs. So, but then if you look on the flip side, what about low inflation or negative inflation, like what happened in Japan in the 1990s, in the last decade? if in Japan, right, you have a deflation, what this means that goods in the future will cost cheaper than today. So on an aggregated basis, most people will withhold their spending. They will choose to save and spend maybe the following year because they know that goods prices will be cheaper then. So this is actually bad for the economy because if let's say everyone withhold their spending, businesses will generate lesser revenue. This translates to lesser profits, less bonuses and wages for you and me. And as a result of that, we'll be forced to cut back our spending, and that creates a negative feedback loop. So this is bad for the economy. And 2% is just nice, the sweet spot whereby businesses can continue to hike prices in their goods and services, and in return generate a positive generate increased revenue and also profits, and that translate to more bonuses, more wages, and then translate to more consumption spending for you and me. And that is bullish for the economy. Moving on to the next slide. So now that we understand why government all target 2% inflation, and now the inflation rate are near like a 40-year high in the US. So what are tools that government often use? There are three main policy tools. First one is monetary policy, and that can be done using rising interest rates. And because rising interest rate will increase the cost of borrowing and also encourage people to save more, so that will help to curb on the demand aspect of it. On the supply side, what's commonly done in China is through the use of bank reserve requirement. So when the market is weak, they might consider cutting the bank reserve requirement, because the bank reserve requirement is the minimum reserve that a banking institute must hold. Anything in excess of that, they can lend out in terms of mortgage loan, etc. So when inflation rate is high, they will choose to hike the bank reserve requirement, and that will translate to less lending activities by the bank, and that will help to curb inflation. Fiscal policies could be in the form of higher taxes, and that help to reduce spending. Moving on to the next slide, slide number 8. So this is a chart that shows you the interest rate hike expectations, and what you'll notice is that central banks around the globe have been using interest rate as the main policy tool to curb inflation. And USA have been the most aggressive on the extreme right column, known as the Fed. So just this year alone, they have hiked interest rate to about 300 basis points, which translates to 3 percentage points. So this is actually a very aggressive method in terms of the pace that they actually hike their rates, and these have severe financial implication on financial assets. Moving on to the next slide, slide number 9. So what so in terms of rising interest rate, how does it really impact financial assets? Firstly, on stocks, it will result in a negative impact because firms will now face increased borrowing costs and thereby reduce their profitability. So it weighs on stock prices, and moreover, this has particularly impact growth stocks more because of the fact that growth stocks tend to be more highly leveraged and they derive more of their profitability and cash flow in the future. So due to the present value effect, the discounting effect of discounting their future cash flow to current value, at a higher interest rate, the discounting effect is more prominent, and that will cause a severe markdown in risk assets. And that's also the reason why you see in today's market, your NASDAQ has fallen much more than your broad-based market indices. For bonds, similarly, is also negative in a rising interest rate, and the reason is due to this discounting cash flow effect. The second reason as to why it's bearish for bonds is also because when the interest rate is much higher, it reduces the relative attractiveness of holding bonds. Just imagine if, let's say, a bond pays you 4% interest, and the risk-free interest rate from placing like a fixed deposit in a bank is at 5%. Would you want to purchase a bond that only pays you 4% interest? No, you probably not. So that will cause this mark-to-market losses, and bond price will correct to reflect that. Moving on to the next slide, slide number 10. So the last asset class that I would like to talk about is on REITs. So REITs is a more tricky asset. So in the short term, REITs, like most financial assets, tend to fall in a rising interest rate environment, and that is because REITs are priced for their dividend yields. In a rising interest rate environment, the dividend yields that you get from holding a risk asset like REITs is become less attractive, so that will weigh on them on the short term. However, this does not mean that investors should avoid investing REITs in a rising interest rate environment. The reason is because REITs performance is more correlated in terms of the strength of the economy as well as inflationary activity. Stronger REITs fundamentals may outweigh the negative impact. So if you look in terms of the bottom table, it shows you the performance of REITs in rising interest rate environment, and they have all delivered very strong, healthy performance the year after the rate hike, as well as through the rate hike cycle. And that is because of inflation. REITs are backed by physical real assets, and when there's strong inflationary activity and strong underlying economic activity, the property prices will actually appreciate, and that would translate to better REITs performance. Moving on to the next slide, slide number 11. As you can see, over the past 1 year, due to this rising interest rate environment, all risk assets such as your APEC REIT, your MSCI World, which is a proxy for global equity stocks, as well as the Bloomberg Barclays Global Aggregate, a proxy for the bond index, have all fallen double digit. Yeah, and then that's to reflect that. So the question is, now that markets have corrected quite significantly from the peak, due to rising interest rate, would it still be a good time to invest? I'll leave that for the later part. Yeah.
Yeah, great points there, Ronald. So you covered why central banks around the world are so concerned over high inflation. I think we all are. But once you set that context, I think that was very, very important. And thanks for sharing that. So going further and pushing it further, what would you say is UOB AM's current market outlook, especially going into the last few months of 2022?
Yeah, thanks, Olivia. So moving on to slide number 12. To answer your question, I think we have to look at the fundamentals of the world economy and make a prediction of how markets will turn now. Because right now, markets fearing about a runaway inflation and also a risk of a severe recession. So let's look at some of the financial market indicators and make an assessment to see how bad will the economy be and if there is still opportunity for us. Moving on to slide number 13. What you see on this slide is basically the GDP growth expectation. So what you see on the right column, 2022 and 2023, they're all in positive territory. So meaning to say that, we realize that growth is likely to be slowing, but they still appear relatively healthy. We don't foresee like a severe or hard recession. Moving on to slide number 14. This shows you the inflation rate forecast for 2022 and 2023. The gray bars are for this year, 2022, and you can see that across the world, most of the countries are struggling with high inflation. But fast forward to 2023, that's indicated in the dark blue line, you will notice the inflation rate forecast for next year have all moderated to a level that's closer to its historical average. So meaning to say that the risk of a runaway inflation is sort of mitigated. And that's what we are also seeing currently in the market, whereby your commodity prices have came down. And we're also seeing that, for the US side, even though they reported peak inflation in 2020, in July, that has actually come off throughout August and also September. Moving on to the next slide, slide number 15. So this shows you the interest rate hike projection for this year as well as next year. What you see is that what we are predicting is for interest rate hike to peak next year, first quarter of next year. And right now, market following the Jerome Powell September FOMC meeting, markets have actually repriced the interest rate hike will peak around 4.4% by December, and in Q1 next year, it will hit a level about 4.6%. So that has already been pricing to the market, and following which the market is actually pricing a rate cut closer to the end of next year. So the key takeaway is that we are now in the tail end of the rate hike cycle. which means to say, the risk of further rate hikes seems to be more limited because market has already priced in the peak level as first quarter next year. Moving on to the next slide, slide number 16. So in summary, in terms of our macro outlook, we think that we are now in a very uncertain environment and we favor risk, you favor quality defensive assets, and we are leaning towards a soft landing view, meaning to say an environment whereby economic activity is lower and inflation rate will be lower. But we are not foreseeing like a hard recession as of now. The current rising interest rate will continue to slow, and right now we are also seeing an emergent opportunity in fixed income, particularly on short end, and that's what you're also seeing in terms of your fixed deposit rates. They are now giving very attractive yields. Long-term returns are actually improving rapidly because we have seen a sharp discount in terms of all your risk assets, whereby your equities have all fallen quite in a high double digit. And this current environment, we like certain assets such as your real estate. The reason is because they can outperform in an inflationary environment. Yeah, back to you, Olivia.
Thanks for setting the stage for us, Ronald. Now, you've presented the analysis, you have given us the context as well, and also, where UOB AM stands for the macro outlook and perspective. So, now I think the key question, and I've been seeing this a lot in the Q&A right now in the feed. Thank you all for your questions and keep them coming. We'll answer them at the end. But for Ronald, really, what then would you say are possible opportunities that people can look out for, and what does UOB AM see in terms of the time horizon going into 2023?
Okay, thanks, Olivia. So that's a very good question. To answer that, can I jump over to slide number 17? Yeah, so as you can see, based on the earlier I discussed in terms of macro outlook, the key takeaway points is that we are now at the tail end of the rate hike cycle, and markets have corrected quite significantly. So we are seeing some emerging opportunities, and the first one that I want to talk about, can I jump to slide number 18? That is Asia Pacific REITs. That is the main topic for today. So why do we see opportunities in this space is because in Asia Pacific region, we are in various stages of reopening. Like in Singapore, we have sort of like fully reopened, but in certain countries such as Hong Kong, Japan, Taiwan, and China, what do you notice about them? These countries they are about to relax their COVID hotel quarantine measures as well as border controls. So we think that this reopening theme will be a key catalyst for growth in this particular asset class. Tenant demand continues to improve across most sectors, and as economic activity normalize, we think that will help to generate a lot more growth in this particular asset class. Just take, for example, during the recent F1 event in Singapore, whereby we have fully reopened, we have seen like 300,000 tourist attendees. So can you imagine when the rest of the bigger ASEAN countries, such as your China, Japan, Hong Kong, and Taiwan, when they relax their border controls in full, then the amount of economic activity, tourism activity it can generate for the region? Yep, so food for thought. Moving on to the next slide number 19. So in order to find out whether is it a good time to invest in REITs, let's first understand the REITs performance in 2021, whereby certain countries actually open up faster than the rest. So what you see on this slide, it shows you the performance of REITs of various countries. On the left side, you have the countries, and on the right side, you have the sectors. What do you notice in terms of the pattern? Firstly, countries that reopened first, which had access to vaccines, had a very strong recovery in 2021. So these are your developed countries like US, UK, and some of your developed markets. But what about the countries that lag behind? They are your China, Hong Kong, etc., because of the strict COVID measures that even till today. In terms of sectors that did well were your industrial, retail, and residential. That's due to the demand from like work from home offices, the drive for e-commerce activity, as well as the opening up of retail malls in 2021. So In terms of sectors that detracted were your offices, because there's less demand for office space right now due to hybrid work arrangement. Hotels, in 2021, travel restriction were a key theme. So many hotels will have difficulty filling up their room rates. So when looking at this chart, the key takeaway is that sectors that have lagged behind will have room to play catch up. Yeah, so that's the message that I want to drive across. And these are the sectors that are currently, in Asia's side, have continued to lag. Now, moving on to the next slide slide number 20. This shows you the REITs performance in this year. So the performance this year is basically in tandem with the general markets due to this sharp rise in interest rate as well as the geopolitical risk between Russia and Ukraine. So the sectors that lagged behind in 2021 didn't have chance to actually, recover and catch up. But just play back. Once this saga is over and when the economic rebound, those sectors that lag would have the room to play catch up. So that's the key takeaway for the past two slides that I talked about. Moving on to the next slide, slide number 21. Is it a good time to buy into APAC REITs? So what you see on this slide, the blue line represents the price to book ratio and the red line represents the price of an APAC REIT. Now, what do you notice about the valuation ratio of the APAC REIT? It's now trading at 0.96 according to Yongshu who just updated me. Yeah, so at a valuation of 0.96, if you look back in history, when the APAC REIT valuation fall below 1, it only happened like in two instances. The first one was during the 2020 COVID lockdown. The second time was during the European sovereign debt crisis. So meaning to say, it's only in severe financial stress that you see valuations fallen to this level. And it's also what we are seeing right now. Historically, the APAC REIT trades around the 1.20 price to book valuation mark. So at 1.0, it's actually a very compelling entry point for investors. And so you are getting an asset class that not only gives you high potential capital appreciation as well as a good dividend yield. Moving on to the next slide, slide number 22. This shows you the properties sectors across the region in APAC. And like all market sectors, they basically go through a cycle of falling, bottoming, rising, and peaking. So on the top left quadrant, you can see there are few sectors that look rather rich in valuation. That these are your residential real estate that we talk about, such as in Singapore and also Australia, as well as certain industrial sectors. But the key takeaway for this chart is that, if you look at the bottom right, most of the sectors such as office, Japan office, hospitality are all concentrated at the bottom right quadrant. And they are moving on to the next phase, next cycle, which is the rising phase, meaning to say they are poised for a rebound. And there are a few catalysts to that, which we mentioned earlier. And these are your, the relaxation of border controls, particularly among the bigger ASEAN countries such as your China, Taiwan, Hong Kong, as well as Japan. Yep, over to you, Olivia.
Great insights in sharing there, Ronald. So we covered the context, we covered the market outlook, and also the key opportunities. And so my next question for you is then, how do they all interplay, and how can investors, especially those right now watching in the audience and also active investors, play into the investment themes that you aforementioned?
Yeah, thanks, Olivia. That's a very good question. So can I jump to slide number 23? So here at UOB AM, we do have an investment solution that plays into this particular theme, and this is called the United Asia Pacific Real Estate Income Fund that's available on the moomoo platform. So moving on to the next slide, slide number 24. So what is this fund about? So this fund offers investors stable return as well as income, and it's lower volatility compared to major asset classes such as equities and bonds because it's uncorrelated, and it offers the opportunity for diversification compared to a regular equity and bond portfolio. And last but not least, it plays into the COVID recovery theme among the rest of the Asia countries. Moving on to the next slide, slide number 21. So what is a REIT and how does it get its returns, right? So a REIT is basically a pooled investment scheme managed by a professional manager to buy into certain real estate property. And in return, they do get rental income. So by investing in REIT, you're essentially a landlord and you earn rental income. And not only that, you also get some form of capital appreciation. In terms of the breakdown, how can REITs managers grow their distribution yield or rental income for end investors? They can do it via two methods. One, through property acquisition. So when you have more properties, in return, you generate more rental income. Secondly, is through rental lease reversion. So once the lease expire, the property manager can actually revise the rental rates, and that can translate to higher distribution income for end investors. In terms of capital appreciation, it benefits from one of the main structural factor, which is inflation. So because REITs are backed by physical real estate, so in a rising inflation rate environment, property prices will rise and that translate to capital appreciation. At the same time, REITs manager can afford to, reconfigure or increase the utility of the property through renovation, etc. And that translate to, improve asset enhancement, and as a result of that, property prices will also rise. Moving on to next slide, slide number 26. So REITs, why does it provide stable income and return? So what you see on this chart is that REITs have outperformed the broader Asia Pacific equity index over the longer term. And there are several drivers as to why this is so. Firstly, it's because a REITs is an alternative asset, so it's uncorrelated, and because of this, there are institution investors seeking to invest in properties, and that influx of money actually help contribute to the long-term outperformance. So like what we have seen, governments always buy office buildings, office towers around the world. Yeah, and so they are also actively investing in this real estate sector. REITs are also characterized by long rental lease, so they provide stable rental income even in market stress, because tenants are obligated to pay rent even when there's financial distress. So it helps to provide that resiliency even during market downturn. And also because they are fully backed by property prices, it sort of limit the extent of the decline in property prices during market downturn. Moving on to next slide, slide number 27, which shows you the breakdown of the performance of REITs. So what you can see is that REITs managers are obligated to pay 90% of their taxable income to shareholders in the form of dividends. So as a result of that, REITs dividend contribute a significant portion of the return. That is represented by the shaded blue line. The light blue line shows you the total return. And if you take the difference of the two, the white color shaded area is actually your capital appreciation. So REITs provide not only high dividend yield, but also long-term capital appreciation. Moving on to the next slide, slide number 28. So where do we see relative value? We recognize that in APAC region is still in various phases of reopening. So our fund manager likes a barbell approach, balancing between defensiveness and growth. So for defensiveness, we like industrial REITs, like for the reasons I mentioned earlier, such as e-commerce activity that is here to stay and expected to grow rapidly over the coming years. Office REIT to play into the broader opening recovery as more people, go back to office, and so there will be increased demand for office spaces. Same goes for retail REIT and hospitality REIT, whereby once Hong Kong, Taiwan, Japan, and China fully relax their COVID border controls, we can expect an influx of activity, just like what we are seeing in Singapore during the F1 event. Moving on to the next slide, slide number 29. Some of the key investment themes that we like, e-commerce. So that can be done through your logistic REITs. We also like resilient assets like data centers to ride the wave of digitalization adoption. We like defensive assets for REITs that have the ability, to imbue rental escalation that are linked to inflation rate. And last but not least, we also like REITs that have very strong balance sheet and they can grow through acquisition, take advantage of the current sell-off in the market to grow their asset base to get higher dividend yield. Moving on to the next slide, slide number 30. So in terms of the fund characteristics, this is an APAC REIT is widely diversified across the various regions, as you've seen, such as Japan, Australia, Singapore, Hong Kong, China, and Philippines. Also diversified across sectors. We have exposure to retail REITs, industrial REITs, real estate, hotel, offices, specialized REITs, and many others such as your data centers, student accommodation, etc. Moving on to the next slide. In short summary, for APAC REITs, it's a very good investment vehicle because it provides you with stable and rental income. Next, the current valuation in this particular sector, like I mentioned earlier, is really attractive. At price to book of 1.0, it really provides a very good entry point with limited downside. And furthermore, given that we are at the tail end of the rate hike cycle, and we have the reopening of Hong Kong, Japan, and Taiwan, they just announced their border controls recently, and they're expected to remove their hotel quarantine measures. We can expect, a stronger recovery in the coming quarters. So that really presents a very good opportunity. Dividend growth is still expected to grow at a very healthy rate of about 4.3% per annum. And there are mitigating factors for the recent rising interest rate environment in the sense that, as the economy normalizes, the activity in terms of the rental income that can charge will continue to grow. There's removal of the rental waiver that be granted to many of these REITs that due to the COVID lockdown that happened during the past 1 or 2 years. And last but not least, REITs managers that have taken advantages of the past sell-off to build up their books in terms of acquire more assets that can help them to grow more rapidly in the coming years. Moving on to the next slide. So for this United Asia Pacific Real Estate Income Fund, is available for subscription both using cash and SRS, and it pays a coupon distribution of about 4.5% annually, and this is paid on a monthly basis. So making it a very good vehicle for investors. Yep, over to you, Olivia.
Thank you so much for sharing that, Ronald. Now, you covered so much towards the end and you ended really strong there with, the different industries to look at, to also look at, different parts of the fund and also, the key opportunities, because that's why we're here for, right? We're looking at volatility on one side of the coin, but then with every volatile period, there are always possible opportunities we can look out for. So I'll be back with you shortly, but before we head on to how you can access these funds with Leong Shern, could I just get you to summarize, Ronald, for me, some 3 key takeaways for our audience watching, because we're getting so many questions, and I think it would be really helpful for you to just summarize for us.
Okay, so 3 key takeaways. The first one, this current rising interest and inflation rate environment is actually transitory. Yes, we don't expect it to be here persistently over the long term, and market sell off is inevitable. But the next key takeaway is market do recover. The market will always recover, and if you have faith and you invest for the long term, you will actually be rewarded. And the third key takeaway that I would like to bring it to you is that, like what Warren Buffett always say, be greedy when other people are fearful and be fearful when other people are greedy. It's easily to get whipsawed by financial news in the market, like we are heading to a recession and stuff. But, for markets, they are always forward-looking, and they do price in, everything in advance. And at the current state whereby, valuations in the REIT sector is actually really compared 1.0, it really limits the risk that you take by entering into investments. Yep.
Okay. Thanks for sharing, Ronald. We'll be back with you very shortly for the live Q&A. So many questions coming in.
Great. Thank you. Thanks, Olivia.
All right, so you've heard the analysis from Ronald, But what about applying what you just learned in terms of analysis in the moomoo app? So right now, we want to show you how you can gain access to UOB's funds and also what else you can do on the moomoo trading app to help you in your investment journey. So I would like to invite Lee Yongshern from moomoo Singapore back into the room. Hi, Yongshern.
Hi, Olivia.
Hi. So why is it important for them to even know how to access this on the app? And why is it even more crucial right now during these times?
Thank you for the question, and thank you for staying here for all the audience. So, what is important? Oh, one of the most commonly asked questions is investors ask us, "What's next? What to do next? How can I execute this strategy? Or whether should I explore on the platform first before I go there?" But why not? Let's take a look at how the professional like myself have been using this moomoo app since day one when moomoo landed in Singapore. So why not let me show you how to navigate through this platform, how to use, how to buy these products. On top of this, I'm also going to show you to buy how to buy other fund products through our platform. Right?
Absolutely. I look forward to your insights as well, Yongshern. And yeah, we'd like to see how you can apply what we just learned and also looking forward to what you're about to share with us. The floor is yours.
Thank you. First of all, please allow me to share my screen. And for those who have your moomoo app on your hand, please feel free to follow me. If you don't follow me, also just keep your memory fresh. Just do remember steps on how to subscribe to these funds or even set the some of the recurring subscriptions. All right. I hope that all of you can see the screen. Okay, so right now I'm in this moomoo app, this mobile app version under this Android tablet version. Don't worry if you are using iOS phone, Android phone, or even iPad. The layout is about the same. It's very similar. So right now, first of all, to find out more about this APAC fund by UOB Asset Management, feel free to go to this Discover and click on funds, the one with the purple elephant. All right, so there are so many options over here. One of the easiest way is either you can type in name here, or you can go to this fund houses. We offer funds from various fund houses, and all these funds has been screened by moomoo fund team. So we onboard team funds that pass our quality screen. So one of it is UOB Asset Management. So you can see this United Asia Pacific Real Estate Income Fund. So right now you can see this is the interface of our the fund interface. Currently you can see the trend chart. And you can find out the historical NAV. And you can change the layout by 1 month, 6 months, or even 3 years, up to 5 years. And you can also see this historical return based on quarterly return, annual return, position details. This is for the first page, and you can also feel free to check out this rating provided by Morningstar. And also, if you like to continue to monitor this and you do not want to make the decision immediately, you can add this into your watch list first. Okay, so to subscribe, I'm sure that a lot of you may want to know what is this RSP about. So RSP is a recurring subscription plan. So you can choose to pay from your moomoo Universal account. But by doing this, you need to deposit the funds from your bank, and it's very easy and simple. You just need to link up the DTA if you are a local bank user. For foreign bank user, you may just do it via TT transfer or even fast transfer if the bank supports. So the subscription amount can be USD $100 as low as 100 US dollar, and you can change the frequency like daily, weekly. Why you want to use daily or weekly or even monthly subscription, this kind of recurring, instead of just putting maybe 10,000, 100,000 into this fund alone? Because I believe that currently there are some investors who are in the more risk-off stand. So I personally myself, I'm also quite worried about the situation right now. But if you like something, if you think that this thing will continue to go up the price or even the NAV, or you have a confidence in this product, why not you just I mean, personally myself, actually I told myself that put a recurring investment, so I can smoothen or I can get the price that is not at certain extreme level, like the highest or the lowest price. Instead, if I'm buying it, let's say recurring every week, I'm getting the average price of her weekly average price. So this is why one strategy that a lot of investors or even myself is using. And another thing is, whenever we get our paycheck, that's the day where we try to put in some funds into this part for our future investment, be it for the retirement or for your maybe family planning. Yeah. If you want to just outright subscribe to 100,000 or 10,000 or even any amount, you can go to this subscription page to try out the subscription procedure. It's seamless, and we do not charge any subscription fees, just for info. Okay, so if you have any coupons, please utilize it as well, because this will give you some returns before even these funds, the NAV grow or even dividends payment. Okay, right now you can go to analysis. You can see the asset breakdown of the holdings. Like for example, there are bonds, there are stocks inside. For this fund, is stock and cash. Real estate, the category. And in terms of the regions, this is a indicative, updated since last in the August, end of August. You can see the concentration, asset size, investment style, and valuation, the PE. And the PB, price to book, currently is below 1. PS, price to cash flow, and a lot more data. In terms of risk indicators, you can also see the maximum drawdown for 5 years, 3 years, or even 1 year. And the Sharpe ratio, beta, alpha, R-square, tracking arrow, all these are available here. If this is not enough, you want to find out more, feel free to visit this summary page to view the fact sheet, semi-annual report, annual report, product highlight sheet, and prospectus. And also, for those who are looking to receive the dividends, you can look at this record date, X date, and also the dividends payment. You can click on to expand. That's about it for United Asia APAC Real Estate Fund, Income Fund. For those who are new to this account, or for those who want to subscribe now or even later or even next month, we can feel free to check out our welcome offer, because we do offer some coupons for you to subscribe our fund products, be it UOB, be it other fund houses. You can utilize this coupons to offset some of the costs or even get some free goodies out of it. If you want to know more about other funds, like you want to do a comparison between the funds and the market index, you can just type in the fund name or even the ISIN code. Okay, and we also have Cash Plus and other products as well. So as you know, Ronald is from UOB Asset Management. UOB Asset Management is also an ETF, exchange traded funds provider. So on top of this, last year they have released another APAC Green REIT ETF. So you can go to this market and go to SG. SG stands for the Singapore market. You can filter the product based on the type. You can go to ETF, sort according to name. So you see this UOB APAC Green REIT. You have an SGD and also USD. So this is the APAC Green REIT. If you want to, you can also take a look at this Green REIT ETF as another alternative if you want an exchange traded product. But of course, there are more REITs and other ETF available out there. Feel free to check out. And also, this is I think this is something the product you can look into whenever there's a good time to buy in. It's good to add them onto your watch list as well. All right, I think that's about it. But if you have any questions, you want to know more about platform, feel free to let us know. Feel free to let us know through this chat or even send us an email. Yeah, that's about it. Thank you for your time. Back to you, Olivia.
Thank you so much, Youngshan. That was very helpful. And I hope those in the comment section and the audience watching, they've got their questions also coming in about the app. But thank you for that and for that short sharing. If you have any more questions, our team is on site. So send in your questions and they'll get back to you as soon as they can. Can I now invite all three gentlemen all into the room again, and we will proceed with the live Q&A. So can I have both gentlemen back in the room, please? Hi.
Hi, Olivia. Hi, Youngshan. I'm back.
Hi, Ronald and Oliver.
Welcome back, Ronald. So, gentlemen, I've got some questions already coming in, and I've picked out some of my favorites. And I think, I've got a good mix so far. So let me just start with the first question, shall we? Let's go straight into it. So the first question, we're going into REITs. Yeah, so because we've talked so much about that in terms of key analysis, what purpose then does the REITs side serve in the overall investment portfolio?
So that's a very good question. So traditionally, right, most investors only invest in stocks or maybe bonds, but in fact, property should be considered as the third major asset class that investors should really consider investing in. However, the thing about property is that, it tend to be very lumpy in nature and it's not accessible to many individuals. Yeah, so REITs actually, has a very, is actually a good replacement to directly investing in physical properties. So what purpose does REITs serve? Firstly, REITs serve as a very good diversifier, like the reasons I mentioned earlier, whereby, it's not correlated, or rather it's lowly correlated to your traditional traditional investment assets such as your equities and bonds. And not only that, REITs also has a very unique characteristic of being a hybrid between a stock and a bond, in the sense that, because they are mandated to give you 90% of their rental income in the form of distribution to end shareholders. So it functions a bit like a bond. On the flip side, it functions like an equity because it's fully backed by real assets, and as a result of that, it plays into the theme of inflation. So it gives investors a long-term capital appreciation growth. So REITs in that sense, through these various characteristics, will make your overall investment portfolio more robust. And the other point about REITs is that it's a very good income contributor for investors who want to build up their passive income, and because of the mandate whereby REITs managers need to pay out 90%. So, through this very asset, it has a very, a good position in the investor's portfolio.
Youngshan, do you have anything to add to that?
Yes, of course. Yeah, so on top of what Ronald has mentioned, so I think investing is a long game, based on my personal view. And also yesterday I just read that I just I think there's one quote by the Warren Buffett. It's about the stock market in the short term is actually a voting machine, but in the long run it is actually a weighing machine. So buying products like REITs and those are kind of a more stable kind of investment. It's not about looking at the capital gain in 3 to 5 days or even 1 month, but instead you are taking a very long view at the market, and the return is will be there for maybe 1 or 2 years if the property market performs well. But generally, this product is the performance as compared to some of the a growth stock is a little bit different, but it is some kind of products that which a lot of people would be looking to invest for a long term for income stream, because it pays dividends. And yeah.
Right. So keyword there, performance. The next question by an audience member: won't the REIT's performance then be impacted by the overall rising interest rates? So how does this relate to the overall environment of the rising rates? Ronald?
Okay, great. I think I covered this in the earlier section. So maybe if I can pull back to the earlier slide. So let us jump back to slide number 10.
Slide number 10. Yeah, so I
Yes.
understand, yeah, you covered some parts of this question, but maybe just to summarize for the audience again, because it seems that we're getting some recurring questions related to the performance of REITs. So
Yes.
would love to know your thoughts on this.
Yes, so we get this question a lot. So in a rising interest rate environment, especially over the shorter term, like the immediate impact after the Federal Reserve hiked the rates, it tends to be bearish for REITs assets. And it's no different. So REITs in the short term will get impacted. But the key point behind this is that REITs, like in this table over here, shows you that they can outperform in a rising interest rate environment. So what are the fundamental drivers? The fundamental drivers to REITs in terms of the longer term performance is actually due to underlying economic activity as well as inflationary activity. In the current environment that we are in an environment whereby growth is slowing, but in terms of the economic data, in terms of economic strength, unemployment rate is still on a very low and healthy level. In terms of inflationary activity, this is actually beneficial for property prices such as REITs. And yes, so over the short term, market will react to rising interest rate because the risk asset get repriced. But if you hold it through a cycle, right, REITs can outperform, and that has been demonstrated in the table below that shows you the different rate hike cycle over the past 20 years. And you can see REITs delivered positive total return as well as the year after the rate hike cycle end. So keyword short term, yes, REITs will fall like all these assets, but the longer term, it all depends on the fundamental drivers, which is economic activity and inflationary activity.
Thank you for sharing that. Now, okay, since we talked about the summary of that, I do want to go to also what you covered in your presentation, and that is about Japan and Australia. So it seems like Japan and Australia are the top two countries, which account for almost 60% of the portfolio. So someone in the audience would like to know, what is the story there?
Yeah, so we understand that for most Singaporean investors, right, they primarily just look at Singapore REITs. But in fact, while Singapore REITs have a good standing among Singaporean investors, in terms of overseas REITs such as Australia REITs and Japan REITs, they offer breadth and also depth. In fact, Australia and Japan, they are the two biggest REITs market in the APAC region. I think in Japan, we are looking at the REITs market cap of about 120 billion US dollars. In Australia, we are looking at a REITs market cap of about $100 billion. So they offers a lot of many different types of investment opportunities. For example, in Japan, we have residential REITs. They are not readily available in Singapore. And then you also in Australia you can get access to certain niche markets such as your agriculture REIT, agriculture farm, childcare centers. These are not really readily available in Singapore REITs. And not only that, just now like the property clock sector, we realize that different countries and different REIT sector perform differently over time. So having an APAC REIT, actually adding APAC REIT to your S-REIT portfolio, will add that layer of diversification and make your overall portfolio more robust in the sense that you're able to get a higher potential return while minimizing the downside risk.
So
Yep.
Yongshen, do you have anything else to add to that? Because I understand when you covered the app demo, you also had different sections where you could also track the analysis for this. So could you just share a little bit more on this?
Yes, okay, Olivia. Yes, in terms of region coverage, I personally think that these two markets are pretty developed. So, the assets are more matured, in my personal opinion. So, having the more matured property doesn't mean that the growth potential is not there. But in terms of returns, I think it's quite decent. But when it comes to stability, I think there's an advantage. And as for Japan, just as everyone is seeing, reading the news headlines, that the yen is actually quite kind of under the water as against the US dollar, against Sing dollar as well. So if this with a lower interest rate environment, and I think it is not really affected by this inflation in Japan alone. But for me, I also would like to just maybe share my personal opinion on the previous question regarding to this interest rate environment. Um, for REITs, it's very unique because not all the REITs are exposed to this high interest rate immediately. Some of them they have this floating debts, and some of them has a fixed rate. For those who have a higher proportion of a fixed debt, then they get to enjoy this booming economic activity, the inflationary environment, and also while still paying the same interest rate in the short to medium term. So that's my analysis. So whenever if I will go to an individual REITs, then I will really look into the portfolio of its debt. I mean the concentration of its debt, like a fixed rate or a floating rate. But for an income fund, maybe I'll take a very long approach where, of course, the risk, the sponsor will definitely manage the risk and according to the parameter they have agreed on. So yeah, that's the inflationary environment. They are affected from the interest rate point of view, but it is also there's also a sign of improvement in the business activities, which is quite conducive for the REITs itself.
Mm-hmm. Okay, so since you highlighted that, someone would like to know in terms of their own investment portfolio, and we can start with anyone. It's open to the floor. So someone would like to know, is it a good time to invest now? Because I'm still recovering from the September dip. So what can I look forward to in the last few months? Because I am not feeling very optimistic at the moment. What are your thoughts on this, gentlemen?
Okay, maybe I'll take this question first. So for us, right, yeah, we understand that the economic situation right now in terms of investment sentiments is very depressing. But let's look back in history. In 2020, during the March COVID sell-off, what actually happened? During then, we were entering a full-fledged of a lockdown. But how did the markets perform? The markets actually enter into the V-shaped recovery, and many investors who were then afraid actually missed out on the rebound. They actually sell and cut loss right near the bottom when the economy was actually entering to a full global lockdown.
Absolutely.
So yeah, so the thing about investing is this: a market is always forward-looking. In terms, some investors right now might be worried about rate hikes and stuff, but that has already been priced into the markets. So for in December this year, they're pricing a rate hike up to 4.4%, and next year, in the first quarter, 4.6%. So this series of rate hikes have already been priced in. But what actually changes? If you look last night, the US stock market actually rallied 3%, and they rallied to why did it rebound 3%? It's because US reported a jobs data that was worse than expected, meaning to say, the economy is slowing. So the market is actually reacting to new news that, the Federal Reserve might not hike rates so aggressively. So immediately all the stock market rebounded. So yes, well, investment sentiments right now is bad, but let's take a longer term approach. If you have the ability to ride through market volatility, then the next question you ask, is it a good time to enter? With a price to book of 1.0 for APAC REIT, right? It's like going to a supermarket grocery store with like a 30 to 40% sale. Now it's a good time to accumulate. Yes, you might not you might want to dip your toe in instead of going all in, because markets can still dip further. But like what Yongshen said, adopting the RSP strategy or buying in tranches can help to mitigate that sort of volatility in your portfolio. So that's what I have to say in terms of the bearish investment sentiment, that being afraid to invest. Having a investment framework taking advantage of dips in the market is the best way to build wealth. Yeah.
Key point right there for the last sentence. So it's about the investment framework. Now, Yongshen, just to add to that, how can the audience really maximize this and to really adopt this as part of how they think about investment and in their own personal finance journey?
Thank you, Olivia, but Ronald stolen my idea.
Sorry, Yongshen.
Kidding. Yes. I think generally we don't want, even myself. I'm very into technical. Fundamental is secondary to me personally. But for technical or fundamental, we can't find bottom. To be honest, we can't really find a bottom. But want to find from the fundamental point of view, if you want to find something that you really like, you really very into something, into certain counter, into certain product, into certain team, if you have confidence with it, uh, I personally think that you can continue to, like for example, using dollar cost, using RSP, don't get into the position one shot, because no one really has the crystal ball to predict the bottom, even with the best technical indicator in the world. There is nothing can predict the bottom. So my take is, instead of finding the bottoms, wasting a lot of time, why not we just continue to do our best, do our homework to find the best opportunity to enter the position whenever you are comfortable, and don't use the money that is meant for something more important. Use on the excess money for your investment.
Absolutely. Thank you so much for sharing that. Especially with, the differing opinions. I think that is very important to have during discussions like these. And I think fundamentally we do want to at least, guide our viewers, right, into making better investment decisions. So the next two questions, the last two questions, I've got one question on currencies. So should we keep the USD for the coming 1 year in lieu of other countries, and also currencies? So what is your thought on this, and what is your outlook in terms of this side of the market? Let's start with Ronald.
Sorry, I was actually muted. Yeah, so for currencies wise, let's look at the US dollar. The US dollar strength primarily is due to capital inflows, because the rates in the US is much higher than the rest of the developed market. So fast forward 1 year from now, if you look at the current standpoint, there's basically across the various region. Japan side, the rates, they're still in their rates is still fairly low. The government has not been hiking rates. UK side, they have been hiking rates. In China, they have not been hiking rates. So in terms of the relative strength among the big geography region, US rates are actually risen the fastest. So as a result of that, that has brought stronger hot money to take advantage of the high USD interest rate, and that translate into stronger US dollar. Now going forward, the question is, what would the other countries do? Will Japan will start to hike the rates, and then will China eventually hike their rates? That's difficult to say, but right now we think that US dollar strength is near on the higher end, and if rates were to cut next year, that has been forecasted based on the Federal Reserve dot plot, there might be that might signal a weakness in the strength of the US dollar going forward. Like it might not be able to continue its strong USD strength as of right now. Yep.
Yongshen, do you have anything to add to that?
I think in terms of currency, that's very subjective, and that is very heavily depends on not only one, but the central banks around the world. So in terms of buying any products which is denominated, personally I'm adopting a diversification for currencies. So I have a portfolio denominated in Singapore dollar and some assets in the US dollar. So and even who knows, maybe in the future there are other currencies which is very attractive and also very important I may also consider. But I think the question that pops up to my mind, whether to buy anything in this kind of environment, the first question I ask myself is not whether to buy it now or not, but the question to myself is whether do I have sufficient savings for 6 months or even up to 1 year of savings for the rainy day. If you have this, then you check the box. The excess fund at a very prudent strategy can be used for other means, which is buying on the dip, or buying on when asset price are very attractive.
Thank you. Well, gentlemen, I've got time for one last question. And I do think this does summarize whatever we've analyzed today. And it's quite an important one. So based on the analysis, since interest rate is targeted to peak in 2023, what is your time horizon for this? And how long should I wait before investing further? Or how can I tweak my investment strategy for the better? What do you think?
Okay, in terms of timing, whether whether to wait for the peak in interest rate to start investing, the question to answer this question, right, we have to first address the earlier point whereby markets have already priced in the interest rate hike. So what market reacts to is basically changes in interest rate expectation, like the example I quoted whereby yesterday, interest rate hike expectation actually mitigated because of poor economic jobs data, and that translated to a very strong 3% rebound in the S&P 500. So it's very difficult and impossible to predict such things, and that a better approach to invest is to have an investment framework and to see and the best entry point is look at valuations. I think a valuation yardstick such as the price to book ratio give you that sort of a fundamental view of is it a good time to enter. And with APEC REITs trading at 1.0, it's to me is a buy opportunity, because as a long-term investor, you know that over the long term market valuations will go back to historical norm, and for APEC REIT is around that 1.2 area. So to me now, it's a discount. Yeah. Thank you.
So Yongshen, since we're going back to the time horizon question, and you also shared some key insights on what to look out for, do you have any comments on this?
I think to summarize what I have discussed in this time horizon, I think generally for APEC REITs, this kind of investment will towards a long time, because it takes a little bit time for the asset in terms of want to be reflected into the NAV. It takes time for asset to get the value, to get a higher valuation based on the economic activities in the country, based on macroeconomic policies and other things. So in this kind of environment, I have actually seen quite a number of people who have discussed with me about a short-term investment in this kind of environment. If you're adopting some market in some directional, in fact, if you have gotten the wrong direction, then the chances of losing money is very high. But if you are making a long-term investment and you're doing RSP or dollar cost averaging, the chances is you may not lose, you may outperform the market, because your cost price definitely will not be the lowest and will not be the highest as well. So currently, I'm quite transparent as well for some of my long-term investment, or even the market is dropped by maybe more than 20%. Currently, I'm using DCA, RSP. My portfolio is down about 18 to 17%. So actually, I'm not saying that I'm very good outperforming market, but having this kind of approach will really helps you to cushion some of the volatility.
Right. Very important. And back to today's topic, navigating inflation and volatility with income. So thank you so much, gentlemen, for answering our hot questions. They were firing away, but of course we answered the top ones that I picked out. And thank you so much for sharing your insights related to this. Now, just to end off the live show, what is just one key takeaway you would like to leave the audience with today? Let's start with Ronald or Yongshen, either one of you.
Yep. So for me, I think the key takeaway that market timing is really difficult, and it's prudent to be a long-term investor, because market eventually do recover, and you should have the faith and conviction in that. As long you invest in the right assets, you ride through over the long term, and there has several fundamental reasons why market always goes up, partly due to inflation rate, which is a structural trend, rising world population that brings about just a point to add on that in the world. Every year, in terms of birth rate, a size of Germany is being born, and that would translate to increased goods and demands and services, and all that will contribute to increased economic activity. And investing the long term will help to mitigate the investment risk in terms of market volatility. Thank you.
Thank you. Yongshen?
So to me, yes, I will repeat again. volatility. So volatility is something that we can't avoid this year. It's very painful. It's a very painful journey to all our investors, to all the people out there who relies on investment, who hope to see a green color on your portfolio. But it's merely a hope only for this year. But think on the bright side, these things may not last. Just like a bull market did not last for too long since I think after March 2020, it lasts until end of 2021. So I personally think that bear market, same goes to bear market, will not be there forever. Things will change, things will turn around, but we just don't know when. But when we don't know when is it going to happen, sitting there and do nothing also may cause you to miss another opportunity. So stay tuned and use a prudent investment approach.
That was Ronald Ng, Vice President from UOB AM, and Lee Yong Shern, who is Senior Manager of Corporate Institutional Sales from moomoo Singapore. Thank you, Ronald. Thank you, Yong Shern, for joining us today.
Thanks, Olivia. Thanks, Yong-Chen. Thank you.
Thank you so much. We'll see you for the next show.
Thank you, everyone.
Yeah, thank you.
See you.
Thank you. So to the audience watching, as usual, always love having you as part of the discussions. And of course, today, very important topic. It's crucial that you take away these key insights from our experts and make sure that you apply it accordingly with your overall investment decisions. Now, if you have any more questions, don't fret, because we've got an email right here so the team can help you. So if you have anything else, shoot away and we'll get back to you as soon as we can. And of course, we've got so many live webinars and shows upcoming. So you want to really stay up to date with our social channels over here, because we're putting all of this together just for you. Because at the end of the day, we take financial literacy very seriously, and we're here to guide you to make better investment decisions. Now, here are some campaigns that you might want to pay attention to. So over here, you've got, of course, the Fight Inflation campaign. And this is really just us being with you, fighting inflation together. So check it out. We've got a couple of talks and live seminars ongoing at our co-working spaces. We even collaborated with the gyms to really fight inflation with an overall healthier lifestyle. So take a look at that. You can look in our social channels. Again, in the previous slide, could we just have the previous slide again? Scan the QR code if you want to find out more. Next one is, of course, the fans of Jay Cho. So if you are a fan of moomoo Singapore and Jay Cho, stay tuned, because we've got some giveaways for the tickets and we want you to relive your memories with us. Last but not least, it's the paper trading competition for charity. So this is very important for us because it's our 10-year anniversary upcoming, and we want you to not just apply what you learned, but also do good for charity. So we're actually donating $1 to Make-A-Wish Foundation for every participant. So be sure to check it out, because we've got our partners on site with us, and together we will not just promote financial literacy, but to also do good for Make-A-Wish Foundation. So check it out if you're interested. Okay, so we've come to the end of today's show. Always a pleasure to have you with us, and I look forward to the next show with you. Stay tuned on our social channels. Once again, I'm Olivia Higgins, and we'll see you next time. Bye.